Every retiree I know is terrified of a market crash in 2026. But the real disaster isn't what happens to the S&P 500. It's what happens inside their own head the moment they see red numbers on a screen. Your retirement account isn't going to get destroyed by some economic collapse. It's going to get destroyed by a perfectly predictable psychological glitch that the financial services industry has been profiting from for decades. And once you see how this system actually works, you'll stop checking your portfolio every morning like you're waiting for a bomb to go off. I'm going to tell you about my neighbor Frank. Frank retired in 1999 with about $400,000 saved up. Great timing, right? Wrong. By 2002, after the dot-com crash, his account was down to around $240,000. Frank panicked, sold everything, moved it all into bonds paying maybe 4%. He told me he was protecting what was left. But here's what Frank didn't know. If he'd done absolutely nothing, if he'd literally gone fishing for 3 years and never looked at his statement, by 2007, his original $400,000 would have been worth almost $600,000. Instead, by the time he realized his mistake and got back in, he'd missed the entire recovery. Frank didn't lose half his retirement in a market crash. He lost it by trying not to lose it. Now you might be thinking that's just one guy who made a bad call, but this is where it gets really interesting. Dalbar does this study every year where they measure what actual investors earn versus what the market returns. From 2001 to 2020, the S&P 500 averaged around 8% per year. Not bad. The average investor during that exact same period, 2.1%. Not even enough to beat inflation. We're not talking about a small gap here. We're talking about the difference between retiring comfortably and working until you're 75. So what I'm going to explain is exactly how this psychological trap works, why the entire system is designed to make you fall into it, and what you actually need to do differently in 2026 to avoid becoming another Frank. Here's the thing about market crashes. They're like house fires. Your instinct when you see flames is to run. That instinct kept your ancestors alive on the savannah. But if you're in a burning building and you run the wrong direction toward the smoke, you die. The crash itself isn't what kills your retirement. It's running in the wrong direction at precisely the wrong moment. And the financial media is standing at every exit screaming, this way, while pointing you straight into the smoke. Let me show you how this trap is built, layer by layer, and why you keep falling for it even when you know better. First layer. Your brain physically cannot process market volatility correctly. There's this concept in behavioral economics called loss aversion. Losses hurt approximately twice as much as equivalent gains feel good. This isn't a preference, it's hardwired. If I hand you $100, you get a little dopamine hit. If I take away $100, you feel twice as bad. This made sense when we were hunter-gatherers. Losing your food supply meant death. Gaining extra food meant, well, you'd probably just eat a bit more. The asymmetry was survival. But markets don't work on survival logic. Markets work on probability and time horizons. When your retirement account drops 10%, your amygdala lights up like you just heard a predator in the bushes. Every cell in your body is screaming, do something, fix this, make it stop. And the thing you do, the thing that feels like safety, is to sell, get out, protect what's left. Except in market terms, that's like seeing a fire and running deeper into the building, because at least you can't see the flames from in there. Now, here's the kicker. The financial services industry knows this. They've known it for decades, and they've built an entire business model around your panic. Second layer. Let me tell you about how your financial advisor gets paid. Most advisors work on what's called assets under management. They charge you maybe 1% of whatever money you have with them. Sounds reasonable, right? But here's what that creates. When you panic and want to sell everything, your advisor has a choice. They can talk you down, explain why selling is exactly the wrong move, maybe show you historical data about recovery times, or they can say, you know what? That's a reasonable concern. Let's move you into something more conservative. Guess which one keeps you as a client? I knew this advisor in Phoenix who told me point blank over beers that his job during the 2008 crisis wasn't portfolio management. It was emotional babysitting. But he also said that the advisors who fought their clients, who told them, no, you're being irrational, were staying the course, Those guys lost clients. The ones who said, I hear you, let's de-risk, kept their relationships intact and their revenue flowing. The system literally incentivizes advisors to let you make the wrong move because the alternative is you fire them and they lose their fee stream entirely. Think about what that means. The person you're paying to protect you from bad decisions has a financial incentive to go along with your bad decisions. It's like hiring a personal trainer who gets paid whether you work out or not. So when you say, I don't feel like exercising today, they say, yeah, me neither. Let's get pizza. But wait, there's more. Third layer, the media makes money from your anxiety. CNBC doesn't get ratings by saying markets are boring today, everything's probably fine long term. Go outside. They get ratings by running cryrons that say Dow plunges and bringing on guests who predict disaster. I pulled this from a Pew Research study from 2023. News articles with negative headlines got 63% more clicks than neutral ones. Fear is a monetizable emotion. Every time you check your portfolio during a downdraft, you're probably checking because you saw a headline designed specifically to make you check. And here's the really insidious part. The more you check, the worse you feel, the more you want information to reduce uncertainty, so you check more, and the cycle reinforces. It's the same dopamine loop that makes slot machines work. Pull the lever, see if you won or lost, feel something, pull again. Except with your retirement, pulling the lever at the wrong time doesn't just cost you quarters. It costs you years of compound growth. I watched this happen in real time during March of 2020. Remember when COVID hit and the market dropped 34% in like a month? My brother-in-law called me, absolutely panicked, wanting to sell his entire 401k. I asked him one question. Are you planning to retire this year? He said no, he had 12 years to go. I said, then what does the price today matter? He couldn't answer that. But he could tell me exactly what Jim Cramer said that morning about a pending depression. He sold anyway. The market had fully recovered by August. He missed it. Now you're asking yourself, if this is so obvious, why does everyone keep making the same mistake? Fourth layer, because the mistake is baked into the timeline of your actual life. Here's a parable. Imagine you're in a casino. You're playing a game where the odds are actually in your favor. Maybe you win 55 hands out of every 100. Over 1,000 hands, you're virtually guaranteed to make money. But here's the catch. You can only play one hand per day. And any day you walk away from the table, you miss that day's hand forever. Now, on any given day, you've got a 45% chance of losing. If you lose 3 days in a row, which will happen occasionally just by math, you're going to start wondering if the game is rigged. And the longer you play, the more painful losing streaks you'll experience, even though the overall odds are in your favor. That's the stock market. Over 20-year periods, the S&P 500 has been positive something like 94% of the time. But day to day, you're almost flipping a coin. Year to year, still pretty random. The returns are there, but they're hidden inside decades of noise. And you're a human being who has to live through every single day of that noise while your emotions scream at you. And just to make it worse, remember that thing about loss aversion? It means you're psychologically experiencing the bad days at twice the intensity of the good days. The game is literally rigged against your perception even when the math is in your favor. Here's a concrete example with real numbers. Let's say you retired January 1st, 2000. You had $500,000. You needed to pull out $25,000 a year to live, adjusted for inflation. If you were in a simple 60-40 portfolio, 60% stocks, 40% bonds, and you just rebalanced once a year like a robot with no emotions, by December 31st, 2023, you'd have pulled out nearly $700,000 in living expenses and still had about $1.2 million left. Your money more than doubled while you were spending it, even though you lived through two 50% crashes. But if you were the average investor with that same starting point, making the average behavioral mistakes, pulling out during crashes, getting back in late, you'd have run out of money by around 2018. Same markets, same starting capital, totally different outcome. The difference wasn't the crashes, it was the behavior during the crashes. Now, to be fair, you might be thinking this is all well and good in hindsight, but what about 2026 specifically? Everyone's saying valuations are sky high. The Shiller PE ratio is at like 35, which is higher than any time except the dot-com bubble and right before the Great Depression. Doesn't that mean we're due for a crash? Here's what nobody tells you about valuation metrics. They're terrible timing tools. Yeah, high valuations predict lower future returns on average over 10-year periods. But lower might mean 7% instead of 10. And they tell you absolutely nothing about what happens next year. Alan Greenspan gave his famous irrational exuberant speech in December of 1996, warning that markets were overvalued. If you sold then, you missed the market nearly doubling over the next 3 years. Was he wrong? No. Valuations were high. Did it matter for timing? Not even a little. But here's where I'm going to flip this entire thing on you. Because you think the problem is predicting whether 2026 is going to be a crash year. That's not the problem. The problem is that even if I gave you a magic crystal ball right now that said with 100% certainty the market will drop 40% starting in June 2026, you still probably couldn't profit from that information. Why? Because knowing doesn't fix the behavior. Let's say you take that information and sell everything in May. Great. You're out. You avoided the crash. You're sitting in cash, feeling smart. Now comes the hard part. When do you get back in? The market's down 40% by November. Is it done? Do you buy now? What if it drops another 20%? Now it's down 50. That feels worse. Do you buy here? What if we're headed to a Great Depression scenario? You wait. The market bounces 10% in a week. Is that the bottom or a sucker's rally? You wait more. It bounces another 15%. Now you've missed 25% of the recovery and you're paralyzed. By the time you're confident the bottom is in, the market's back to where you sold. You made $0 and spent 6 months with an ulcer. This isn't theoretical. Fidelity did this analysis of their account holders during the 2008 crisis. The people who had the best returns were either dead or had forgotten they had accounts. I'm not kidding. They literally couldn't panic sell because they weren't aware they owned stocks. Everyone else who was actively managing, trying to time it, got destroyed. So here's what actually happens to retirement accounts. And I want you to really sit with this. The money is there. The returns exist. 8 to 10% annually over long periods, like clockwork. But it's locked inside a box. And the only way to open the box is to do nothing for decades. Every time you touch it, you reset the timer. Every time you take action to protect yourself, you're actually just guaranteeing you'll never get what's inside the box. The financial services industry has built a $30 trillion ecosystem around making you feel like you need to do something. Because doing something generates fees and commissions and trading volume and advisor billings. But the optimal strategy, the one that actually works, is the one that generates the least revenue for everyone else. Just leave it alone. Now, I'm not saying stick your head in the sand. I'm saying the actions that actually help are boring and have nothing to do with market predictions. Here's what actually works. 3 things, and then I'm done. 1, build a cash cushion that covers 2 to 3 years of living expenses. That's it. Not because the market might crash. Because if the market does crash, you won't have to sell stocks at the bottom to buy groceries. You'll have cash to live on while you wait for recovery. This is the financial equivalent of keeping a fire extinguisher in your kitchen. You're not predicting a fire. You're removing the panic if one starts. My neighbor Frank didn't have this. The moment he needed money and his portfolio was down, he had to sell at a loss. If he'd had even 1 year of cash, he could have waited it out. 2, rebalance mechanically once per year. When stocks go up, they become a bigger part of your portfolio. When they crash, they become smaller. Rebalancing means selling a bit of what went up and buying a bit of what went down. This forces you to buy low and sell high without requiring any market prediction or emotional willpower. It's automated good behavior. 3, stop looking at your account unless you're rebalancing. This sounds stupid, but it's the most important one. Every time you check your balance during volatility, you're giving your amygdala another chance to hijack your prefrontal cortex. You're not getting useful information. You're getting emotional stimulation. Checking your retirement account daily is like weighing yourself after every meal. The short-term noise overwhelms the long-term signal and makes you do counterproductive things. That's it. That's the whole game. The biggest threat to your retirement in 2026 isn't a market crash, a recession, inflation, or any external event. It's the 3 pounds of meat between your ears that's wired for survival on the African savanna, not portfolio management in a modern economy. And the entire financial system is built to exploit that wiring for profit. Once you see it, you can't unsee it. And once you can't unsee it, you stop worrying about whether the market's going to crash. Because the market's going to do whatever it's going to do, and your job is to not let your brain trick you into snatching defeat from the jaws of victory.